Good morning. This is Amit of UBS's economics team. Equity markets continued their downtrend. The euphoric response to the policy initiatives have more or less evaporated across a range of markets as Fed Chairman Bernanke provided an exceptionally downbeat outlook of the U.S. economy. These comments follow weak retail sales data in the U.S., a bleak assessment of economic conditions in the latest beige book, and a jump in unemployment in the UK yesterday. The S&P 500, for instance, lost 9% yesterday to close at 907, not far from the low of 900 reached last Friday. The Nasdaq index has in fact dropped below last Friday's lows. These concerns reverberated across Asia, with the Nikkei 225 down 10% and the Hang Seng 8% lower at the time of writing. The U.S. economy, together with the euro area and the UK, will suffer a recession. But we argue that the policy actions taken so far, and those that policymakers we expect will take in the future, will help. Quite apart from generous liquidity injections, and here it is worth noting that the ECB expanded its list of eligible collateral yesterday to include any paper down to BBB-, the ECB and other central banks, including the Bank of England, have plenty of ammunition on the policy rate front. The Fed can also cut further, and if it were to approach the zero bound on policy rates, there are a range of unconventional measures it can adopt. Bernanke himself has discussed in the past the possibility of influencing the yield curve well beyond the shortest end at which the Fed usually operates. They could do this by committing to hold policy rates low for an extended period of time, for instance, and at the same time, they can keep injecting liquidity in the markets. In our view, these measures will not be necessary. The economy will respond to the rate cuts and the other initiatives, but in the meantime, the euro area economy will slip into a short recession by historical standards that will probably last around 2 quarters, along with the US, which will shrink for around 3 quarters, and the UK by 4 quarters. Turning to the data calendar for today, we have nothing of any significance in Europe. Over in the US, we get CPI inflation data, which on the core measure is set to stay unchanged at 2.5%. The outlook, though, is clearly on the downside, especially with oil prices dropping to $73 a barrel. Amidst all the gloom and fear over the past year or so, perhaps it is worth stepping back and celebrating one great success over this period, and that is inflation. Inflation at the consumer level has been remarkably well behaved across a range of economies. Even with oil at $150 and record levels of food prices, headline CPI inflation peaked at around 5.5% in the US, at just 4% in the euro area, and at around 5% in the UK. We have long argued that inflation was yesterday's story. We now see inflation below 2% in the euro area, the US, and the UK by the middle of next year, and the risks to that are very much on the downside. The fear is not high inflation, but rather a debt-induced deflation. Apart from that, we get U.S. jobless claims today and the Philly Fed survey. That is all for today. Have a nice day.